Welcome back to OK Computer. I'm Dan Nathan. I am joined by Trevor Marshall. He is the CTO and he is the co-founder of Current, which also is our landlord. Trevor, welcome back and thank you for having us.
Yeah, thank you. It's like so nice in here now.
We're getting that kind of tricked out here,
really
right?
coming together.
Coming into its own. You were one of our first OK Computer guests. I think we were probably doing it from a rental unit somewhere. It was like it was embarrassing.
This is way nicer.
It's way nicer. We got to it. Listen, we got a big show for you today here, people. We have our second edition of Funders and Founders. We have Ethan Agarwal. He's the co-founder and CEO of The Coterie with Ajay Kamat. He is a partner at Pear VC, which led one of his very early rounds. We have a great conversation about the relationship between these two guys. We talk about the business of Coterie, what Ethan was doing before, and how Ajay had caught his attention prior to the founding of The Coterie. That's a great conversation, so definitely stick around for that. Brought to you by our partners at RBC Capital, the Funders and Founders series. And also later this week, Guy and I are going to speak with Kara Swisher about her new book that's yet to come out. I've already read it. It's called The Burn Book, and it's awesome, people. And the first 100 listeners who leave a review of OK Computer in the Apple Podcast Store, we're going to send you a free copy of that book. You know the drill. Send a screenshot of that review to contact@risk-reversal, and Amanda will send you that book. All right, dude, bigger news though. We walk in this morning, we were filming this, recording this Tuesday afternoon, Trevor, and a huge deal, not just in your space, but in the entire market. I think it's the biggest deal in a very long time since some of these big oil deals. It's Capital One Financial is spending $35 billion of their stock to buy Discover Financial. All right, let's break this down. When you saw that headline cross last night, what were your thoughts? We want to talk about what are the implications just in traditional finance, but also fintech, the timing of this deal, like everything from your guys' perspective.
Yeah, it's huge. I mean, not just in the dollar value, which is, of course is like interesting to everyone who's in the space, but just like the potential for what this could be, obviously, is what they're planning towards, the incorporation of the network. That's really what it's about. You've got, two of the top 10 issuers coming together, and Discover bringing Discover Network, Pulse, Diners Club, and actually creating sort of a closed loop ecosystem potentially with all of the Capital One. Now, what does this mean for Capital One's relationships with the other networks? I'm sure there's tons of commitments that are in place, but longer term, really taking an Amex approach to what has been more near very bottom of prime customers in a way that Amex doesn't really go near. It's super interesting.
So let's talk about that. So the network, right? So when we talk about these sorts of businesses, one of their biggest expenses is network fees, right? So like MasterCard gapped down like 3%, Visa was down like 2% as lows. They've come back a little bit. One of the headlines that I saw is that Capital One is targeting network synergies, and I assume that means fees. So talk to us a little bit about that, how this potential deal. And again, regulators are going to come all over this thing because the combination of these two companies makes them one of the biggest card issuers in the country.
They'll be up there. If not, I mean, JP Morgan's at the top. I don't know if this combined deal, I'm sure that someone done the math on this
I think it's
already.
like maybe 16, 17% or maybe a little higher.
Yeah, it's going to be huge. And I think when you look at I mean, it might be helpful just walk through a little bit for people who are not familiar with how issuing, acquiring, and all that the payments networks work. In these, Visa and MasterCard, they operate what are called open loop, which is they've got issuers, which are generally banks or other financial institutions that give cards to people, and then acquirers, which are the merchants. Those are two completely disconnected entities, and you've got the network in the middle disintermediating the connection. So they're routing, when you go and you plug your Visa card in at Walmart, that runs through their rails, goes to whatever bank that's from, who can sign up to be an issuer on the network, approve it. And Visa brings a lot of value. Like open loop networks are extremely complicated and they're very sticky, but it loses, there's a cost to that. There's a cost for not having both sides. And then you get someone like Amex who verticalizes the whole thing. And if you're signing up for Amex as a merchant, you have an Amex account. If you sign up for Amex as a customer, you have an Amex account. Amex on both sides, they can remove a ton of the sort of the middlemen in the process and take that as margin. This is what Capital One is likely going to be doing over the next 5 to 10 years, as hopefully they'll get those synergies sooner from their perspective. But as they roll off their existing commitments with some of the open loop networks like Visa and MasterCard, moving towards owning the customer and the network, and I'm sure eventually some of the merchant side too is probably in the horizon. This should be a huge margin expansion for them.
So what does this mean for you guys? When you see this headline, I mean, you and Stuart, you founded this company. A lot of the things that you just described that COF does and Discover, and then the MasterCard and the Visa, you were looking to actually get within the seams. You were looking to kind of disintermediate some of those processes. You were looking to take market share from some of these companies. What does this sort of mean for you? I know it doesn't change your mission at all. You guys are still serving a client base that you feel is underserved by the traditional financial services. But what was like some of your initial reactions? Because I'm sure you guys were either on the phone very quickly with each other, had some sort of Slacky thing going on or something.
Well, quite frankly, like where Current sits, we serve customers that are not served by even like Discover or Capital One. These our customers generally don't have great access to the credit system, and they're very much, this is sort of the near prime specialists, but for deeper subprime and sort of the types of customers that we serve that have trouble with banking access, let alone credit access. It's a different space. And I don't think them coming together is going to change that fundamentally. I think what could be interesting is really Amex's response to this, because Amex basically has a similar setup in terms of this more closed loop approach. What has been interesting to me is to see Amex start to bridge out and start to open up the issuing to other issuers that are not just in Amex, them moving a little bit more towards these open loops to try to look at a wider distribution says a lot. It probably maybe was an anticipation of something like this. Most likely not, but I think they're going to have to figure out how they distribute going forward as this Capital. I don't even know, what are they calling it? Is it just going to be Capital One Discover?
Well, let's talk about from a regulatory standpoint, because again, you guys obviously have been building for years when you think about Current, and obviously you're pretty familiar with your competition, and you just mentioned that you're on a different part of the spectrum as it relates to the customers that these two companies serve, but then obviously American Express is on the way other end of this. How do you think regulators will view this? I mean, do they like to see, if JP Morgan is nearly 20% of an issuer here in the States, does a stronger number two kind of help their cause from a regulatory standpoint?
Total speculation. It's going to be whoever's making that decision. I think you can make the argument either way. It's like, great, now you've got a counter to number one. And great, maybe you actually, I think the stronger argument would be you have a more realistic counter to Visa, MasterCard, which is sort of a duopoly in terms of the payment networks. But at the same time, you are talking about someone coming together and taking a massive percentage. It's not a majority, right? And so I think like the argument about this being like either antitrust or like this is way too much control, I don't think that's. There's been regulation that prevents banks from getting too big in terms of like deposits for a very long time, and sort of set up because it's an attempt to mitigate systemic risk. So I don't know. You could be on either side of the argument. It seems like something that's probably good for the customers of both of those companies. Like if there is that level of synergy and there's that margin expansion, in theory, that should give better pricing in a trickle-down way to their customers. In reality, that probably just accrues to the shareholder value, but in theory, it should be good.
Let's talk about the shareholder value, because this is like a Capital One. It's obviously it's down from its all-time highs made a couple years ago. It's just below 140. It was 180 at the highs in 2021. And here's a company that's expected to grow earnings, let's say 10% this year on low single-digit sales growth. Trades at a 10 multiple. Okay, so a 10 PE, like half of the market multiple. On the flip side of that, American Express has just made new all-time highs. It's up dramatically. It's gone literally since late October from about $140 to about $213 where it is today. So again, all-time high, above $150 billion market cap. And when I think about its multiple, it's trading still below a market multiple, but much higher than that of a COF. So it's about 15% expected earnings growth this year on like 9-10% sales growth, trading about 16.5 times. So it's interesting to see the multiple disparity for higher growth. Is this a reflection on what the market perceives to be that when the consumer does weaken, if we do go into recession, a Capital One is going to have a harder time than American Express at first?
Yes, yeah. I think you have to split out the credit side of the business of what's generating the equity value there from what is, in my opinion, the more interesting part of this deal, which is the network value and sort of the longer term product value that comes with it. But Discover's last earnings before this, you can see consumer delinquencies hitting levels that were not expected, and in sort of this softening in the more near subprime, near prime customers as they come out of Christmas. Tax refunds haven't hit yet. You've got much higher credit consumer delinquencies. That should be like a bit of an anchor on the price. Because we have to like go through that, and it's going to be very similar to Capital One's performance.
That is really funny. I've noticed. Listen, I've been in this business for 25 years, and I've noticed that no one makes deals like at really bad times in the market or the economy, like these sorts of M&A sort of transactions. They do it usually when people are feeling a little better. And just to put like some sort of context on this, this Discover Financial is trading at $125. The deal, it's because it's going to take a long time to get through. There's going to be a discount placed on the $35 billion value. So it's not trading at the value. It's also going to trade with COF stock, right? As that moves, because it's a stock for stock deal. But this DFS was trading at a 52-week low at $80 at the end of October, and now it's at $125. So, and before the deal was announced, it was $110. So my point is, it's kind of interesting that, we've already seen delinquencies starting to pick up, loan loss reserves pick up a little bit, and it's interesting to see this sort of deal now.
Yeah. I mean, for sure, this is like, when you look at the network value, this has got to be a multi-year. This has been in the works for, hey, as Capital One or as Discover. I'd love to know what those conversations looked like over the years, because we would know obviously for sure. But it is a much bigger strategic play here when you think about how do you internalize the flow for hundreds of millions of consumers. And what implications does that have by being part of the network and knowing who the merchant is a lot better? Can you make better risk decisions? So can you expand credit offerings with the power of having that network and the risk logic and decisioning logic built in? So there's a lot, like when you have better data, you make better decisions, and owning the network in addition to the customer means that you're just going to make better decisions. So you should be able to create a asymmetry in the pricing of the credit that you're offering. So there should be, it's more than just hey, we'll internalize the network costs. This should be over the, 5-year horizon. We should be able to, offer better credit to more people.
It's interesting that JP Morgan hasn't missed a beat. You'd think that this is a competitive sort of effort towards, let's say the behemoth, and the stock is literally at all-time highs today. It's up on the day. It doesn't, no cares whatsoever. Let's bring it back towards, let's say let's bring it back to Current and the business you guys build. What does this mean for, let's say, fintech? And we don't actually have to speak specifically to Current, but obviously, a lot of folks out there who are building a whole host of different products that range in and out of, from the network to the actual offerings and the like here. What does this mean for fintech? Like if you guys were all in this big group chat, what would be the common, the common sigh here?
The common thing is big deals are great, just generally, right? Transactions happening. Like if you look over the last year, there's been a tremendous amount of gun shyness, not just on the IPO side, but even in private capital, and to show that there is appetite to do things, and it's in the sort of broadest stroke possible. This is a very big thing. It shows that energy is coming back into the system. Like you said, deals don't happen when the market is just bad. So what that allows folks to see is that, okay, there is certain conditions in which you can be more strategic, and if some of the biggest players are getting more strategic, it should be a call to arms to a lot of the other issuers in the space, maybe some of the networks in the space of, hey, things are happening. How are you going to parry this? And that has a tremendous amount of impact into things like business development at sort of competimates that they might be working with, other networks, other big banks, other fintechs. So this will kick off a lot of conversations, and those conversations will turn into deals.
Yeah.
And so like having a big, splash in the water, the ripples will go on for a long time.
It's funny from my perch here, I know a lot of VCs. I know a lot of VCs who are very focused on fintech. It seems like there was some stuff that was definitely percolating over the last couple of months or so. Really, a lot of VCs thinking about how companies who made it through this very difficult period over the last few years, how do they put a couple of these companies together and 1 + 1 = 4 or 5, right? Because if they made it through, some of these difficult times that we had in the post-COVID era, and it was weird for consumers. It was weird the way that, they were flush with cash, the way that they spent it, the way that they couldn't spend it at different times, and just some of the kind of technology they become accustomed to, right? The peer-to-peer, and a whole host of things, right? So it's interesting. It just seems like there is, things feel pretty good right now. And another place where things feel pretty good, which is near and dear to your heart a little bit, is crypto here. And so I'm looking at a chart of the Bitcoin. It's just above 52,000. It was probably a little above 53,000 a week ago. It's probably 170% or so off of its lows from a year ago. And the year ago lows, interestingly enough, came as some of the biggest regional banks in our country went under. So we're almost on the anniversary of that, which I also think, so it's interesting that we have this huge deal announced, a year after that period. But back then in March of last year, it was interesting that crypto sold off with traditional risk assets or so, right? So we had this run up, into the spot Bitcoin ETF, and people were pretty geeked up about that, sold off. And then it's rallied, and it's rallied as the dollar has rallied, which is kind of interesting.
Yeah.
And you know what's also interesting? Gold hasn't rallied. So your nerd gold has rallied a lot. And then gold, which you probably don't own any of and never would or anything like that.
I own Pax Gold.
Do you? Okay. But it can't get out of its own weight. So talk to me, what's going on with Bitcoin? Because obviously you could tell I got my haircut this morning. It looks pretty good, right?
Yeah, it does look
and
good.
So my barber, Eddie, who is a maestro, by the way, okay? And he trades a little bit of crypto. He's asking me, what's up with Bitcoin? I said, you know what? I'm going to talk to my boy Trevor today. You're going to have to listen to the pod tomorrow. So what is going on with Bitcoin? Because if you think about what happened at the end of 2022 with SBF and XTX and all that sort of stuff, and it was just a crescendo lower. People were freaked the you-know-what out.
Yeah.
And then the regional banking crisis, and then the fact that it seemed correlated to those traditional risk assets in the financial sector. But here we are a year later from that. It's a very different story.
Yeah. Well, I think this rally is definitely different. Like this feels like private flows related to the ETF. And the way it feels different is there's almost no consumer exuberance in the way that there was, 2 years ago, 3 years ago. You've got a SBF's first prison photo released. So, the past is a little bit behind us. FTX claims are paying out at 100%. And so, people are looking at the fallout.
Explain that for a second. So the beef is that they had FTX, which was basically a brokerage for all intents and purposes, right? A crypto brokerage. And then they had this hedge fund, Alameda, right? And so when Alameda borrowed money, right, supposedly from, not supposedly, it was ruled against them, against FTX, and used it to do a whole host of things, not pay off, I guess there were payoffs, politicians and, trips and this and that and everything. And then they were trading and they came up with all these strategies. How is it though, then FTX customers, is it STF customers are getting paid back at 100%? It's the Alameda investors who lost money?
So the way that the claims are getting paid out, so you've got, the way that people lost money is you put your money into FTX, you're trading. Yeah. You've got, let's say, a Bitcoin there, right? And then it shuts down, you can't withdraw, the Bitcoin stays there. So people had crypto assets that were sitting on there that had a certain dollar value at that point in time. What FTX was doing with that cash was they made a lot of private company investments. So
VC stuff. Yep.
Yeah, they got the big AI investment, which is actually a large part of why they're able to pay the claim back. There was also a ton of crypto that was still there that they were able to make available, claw back the prices up, which helps quite a lot. I don't know if the claims are being paid back in the crypto or in a dollar value marked at where it went under, which was a different price.
Yeah, very different.
I very fortunately, as a U.S. Resident, I didn't have an FTX account and wasn't sort of involved with that. But there is like a feeling that we, as an industry, have kind of moved through that situation and a little bit past it. There's a sense of closure, and certainly having now very legitimate ETFs out in the market has been the main focus when you talk to people who are a little bit more informed. But there, like I said before, there's none of the same like NFT style exuberance.
It's going to come though. I mean, like, think about it. Like what there's going to be something that comes next. And I want to get to WorldCoin in a second here, but like, I'm just looking at like Coinbase, for instance. Okay. So Coinbase just rallied in the last, like month or so, like 60, 70%. Okay. Yeah. And they put up this quarter and investors liked it and the stock was rallying. And I'm looking at this and I'm saying for 2024, they're supposed to do, $4.24 billion in revenue, 4.46 in 2025. I'm looking at GAAP earnings, and they're supposed to do this year 97 cents, next year 75 cents. So it's trading at 147 times this year's earnings, 170. So the whole narrative to me about all these spot Bitcoin ETFs being listed is that for a lot of folks who want access to this market, they can just do so now with a Fidelity ETF, and they can put it in an IRA. They don't have to have a wallet, right? Or any of that sort of stuff. They don't have to be fearful of a lot of the shenanigans that were going on in some of these exchanges that were regulated. Now Coinbase is obviously, a stalwart here. They made it through a couple crypto winters. They seem to have taken a lot of share. They're going to be doing a lot of custodial work, right, for a lot of these ETFs. Talk to me a little bit about that, because there's still not many ways for folks to express views other than actually buying the coins. Now you have the spot ETFs. There will be others. There will be an ETH, right? ETF, that sort of thing. But Coinbase has clearly been one that people in the equity markets have reflected a view on. So talk to me a little bit about that, because it's still really volatile. And this is a company that is not hockey sticking anymore. You know what I mean? As far as growth in earnings and sales. And you could make the argument that they might have tremendous headwinds if these ETFs lower the volatility, you know what I mean? And therefore the bid-ask spread gets smaller, and they're going to be able to charge less for their fees on that.
Yeah. I mean, I think you already called it out. Like Coinbase is doing a lot of the custody for these things. They have changed their focus internally to be a lot more about market aggregation and standing up the trading infrastructure, which is not as consumer facing. Higher consumer trading volumes, that's still a large part of their business, but they've ever since their acquisition of Bison Trails, now I think like 4+ years ago, they've been moving more and more towards the coin infrastructure as a service, which is now going to be the backbone for a lot of these much bigger, much bigger things like the ETFs and larger trades. So I think they're emerging and continue to go in this direction of more of an infrastructure company than a consumer company. That's where the stability will be, because they're going to be charging, software fees instead of trading volume, and that's where the business.
But there will be a transition as investors have to figure that out a little bit. So right. It's kind of interesting to me.
Trading volume still dominates.
Yeah. You're probably, though, if you want exposure to this space, you're probably, and again, this is not a recommendation, but you're probably better off getting exposure to actually Bitcoin, whether it be through
it's always been the case,
than Coinbase. So you know what I mean? Right now, where it is right now at multi-year highs. And again, so I just find that really interesting. And so I think the next thing that you and I are both waiting for is to see what sort of silliness comes back, right? Whether it's, what sort of NFT stuff or whatever. And the last thing I'll just say about Coinbase is Brian Armstrong means business. Whenever I see him on CNBC now, he is wearing a suit and a tie. It's no longer, you know what I mean? Like the wrinkled T-shirt or anything like that.
Institutional, right?
I want to talk about what's going on in the markets today specifically. Again, this is Tuesday afternoon. You and I and Stu, we chat about it all the time at the water cooler. Well, not all the time, but every once in a while. What's going on in the AI space? At first, after ChatGPT was launched in late 2022 and caught the markets by storm. It was really, it was the hyperscalers. It was, it was Microsoft, and obviously they had the catbird seat as far as, the investment in OpenAI and access to ChatGPT and how they're going to integrate it into, their productivity tools and the like. And Google was always, chasing with Bard, and now it's Gemini. And then there's upstarts like Perplexity, which I've been using a lot and really like. And so I actually think it's interesting that people right now are talking about Perplexity relative to Google the way people were talking about Google relative to, let's say, Microsoft and some of the embedded things like, back in 2000, 2001 or so. We're in an interesting period, but a lot of the focus this year specifically, the massive outperformance has been the semiconductors, and NVIDIA in particular at its highs last week. I think it had gained $850 billion in market cap this year alone, and they're going to be reporting Wednesday. By the time you're listening to this, it's probably going to be Wednesday afternoon. And it seems like some of the air is coming out of this a little bit. And I'm just curious how you think about that, because you're a builder, you're more of a software guy. But when you think about it, I'm sure all your friends last year were scurrying around trying to buy these high-end GPUs to do whatever it is in any business, right? That wanted to integrate or wanted to train these models or integrate them or, have the servers to kind of operate this. Talk to me a little bit about how you're thinking about this year over year, because you and I did talk about this a year ago when the Bard launch didn't go particularly well and people were really excited about ChatGPT 4. And I'm just curious, give me your, the 411. It's not stock market call or this and that, maybe more from a vibe check, if you will.
Yeah. So I think a year ago I talked about, I think ultimately the ones who win are the ones that have the servers and the cloud infrastructure. So I'm still quite bullish on Google being able to be the main market dominant player here. I mean, with OpenAI's integration with Microsoft, they also have access to a tremendous amount of, workload capable machines. If you look at the Bard, Google's terrible at when it comes to branding these products, but generally what they put out is sort of best in class, and you can see that in their cloud offering too. Like the products that they offer, they're things that are down to the physical wire better than competitors. And Gemini 1.5, which was announced last week or the week before. I'm not sure if you saw the demo where they uploaded a 40-minute video, and that kind of stuff is the expansion in sort of the context that the model can have is extremely impressive. And the team at Google is this is, when I talk to folks at Google Cloud who we work with, it's one of their sole focuses, and the acceleration and the product availability has been so extreme that it's a little almost unhinged how quickly they're releasing stuff. I still think that whoever has the servers and then ultimately the team to come up with better and better techniques will have an advantage. But let's not forget that at the end of the day, once there's a trained model, the cost of doing one of those inferences is extremely low.
Yes.
So it only takes one licensing agreement from Google to someone else to just license this relatively, once the model is trained, other people can pick up the inferencing
on their
side.
Cloud. And so that's why
I think the economics of how this market develops isn't super clear yet.
Yeah.
You've got Sam Altman coming out talking about raising trillions of dollars for semiconductors. And my gut reaction to it is it reminds me a lot of when ASICs, so application specific integrated chips, were being developed for Bitcoin mining. And there was this huge gold rush around developing smaller and more efficient chips. And ultimately that still makes sense because you have to run the algorithm. You have to create hashes that you're submitting to the Bitcoin lottery in order to win a block. But that's not the case with these models. The work is done up front, and then inferences are very cheap. And so what will be, I think, really interesting is the economics that evolved as we go more and more multimodal into video and probably eventually live stream types of workloads is going to be all the infrastructure around the model, which is how well can you store video? How well can you what is the processing throughput to these things that are not machine learning, based, but are just cloud infrastructure and infrastructure based. So I still think Google has like a huge advantage here, and we'll see how things evolve.
It's interesting that you feel that way. And I think a lot of folks who know Google really well, and they've seen like how they moved into the cloud, over the last 10 years and how they've taken share from Amazon and really kind of held up well against Microsoft and the like. The stock has actually been in the penalty box a little bit, not for the reasons that you just mentioned, for the reasons about Bard, the reasons about Gemini not looking up to snuff as it relates to, let's say, GPT-4, which is interesting because, Google trades at a market multiple versus a Microsoft that trades at 35 times its earnings at one of the highest multiples it has in a long time. Obviously, Amazon's a bit more expensive. So it's been put in the penalty box for not having the commercialized product that people are getting excited about right now.
I think that's the voting machine at work, which is it doesn't look like a winner right now.
Yeah. Well, they don't even have an iOS app. Like the fact that they announced Gemini Advanced without an iOS app seems kind of odd. Now, obviously, they're very entrenched with Android, but it just seems to me like if you want to compete.
Yeah, they haven't yet, and this is so typical for a lot of the other cloud stuff. The go-to-market is a bit messy, but ultimately, if they're able to tie it in to the full cloud offering, which is where the bigger like the apps, like frankly, they're cute, like they're it's fun.
Yeah.
But I have ChatGPT Plus. I think it's really fun. I enjoy it. I get capped out after an hour of using it, and I can't do anything useful in it because I get capped out before I can do anything.
Even with the paid version?
Even with the paid version, I cap out because I'm testing the limits on like what it can do with file manipulation and some of this. It's probably just using it's heavier usage than others, but it's just the limits are so like. They're hilarious. Like it's a magic when you're using it, and then you hit a limit and you're like, well, I guess I can't actually do anything useful with this. And so integrating it actually on the back end into products is the way that this stuff will distribute, where you're doing, thousands of inferences a minute for most platforms. And so Google is better positioned to wire that stuff through. Like I don't know that many startups that are on Azure. There's a lot of government workloads on there, and there's a lot of sort of big enterprise that's on there. But in terms of people who are generally pushing the boundaries, most of us build on AWS and GCP, and AWS doesn't have a great answer to this yet.
But I guess if I was Microsoft, I'd be pretty happy for the government connection, like
for sure,
for this thing to go and go. And the last thing I guess what I'll just say here is that I think there needs to be a cooling off period a little bit. Just when you look at NVIDIA gaining the way it did, it went from $500 to $800 essentially in a straight line before, based on what their customers and their competitors had to say over the last month and a half or so. It just seems like a lot of enthusiasm has been pulled forward. So the moment that we see, and every day I see a new headline in the information about how Microsoft is looking to diversify away from the reliance on NVIDIA, creating their own things, designing their own this, and we keep hearing that. And so ultimately, I just feel like NVIDIA is going to first have a quarter where they don't beat as much as people expect, and they don't guide as high for the next quarter as people expect. And then there's going to come a quarter this year where they actually guide below where consensus is, and then it's over. Like meaning the premium comes out, because then to your point, there was a credit analyst 2 weeks ago at Barclays. There's not a single analyst on Wall Street, and there's like 50 some that cover NVIDIA that have a hold or a sell on this stock, I think, most of them have buys. There was a credit analyst who made the exact point that you did. He's like, they're funding their customers, A. B, once you go from this training phase to the inference phase, there's going to be much less demand at a time where a lot of their customers, and they have a huge customer concentration. It's Alphabet, it's Microsoft, it's Meta, and it's Amazon. I think they're like 45% of their, as soon as that slows down, they're kind of done. And once that happens, then I think it gets over to the software guys. It gets over the hyperscalers. And so that's what I'm worried about right here. Does that make sense to you?
No, that's exactly right. That's the thing that I don't think is fully appreciated yet. And I think that credit analyst is exactly on, which is, this is different than like ASIC development. Like ASICs in Bitcoin, you need to run them in order for the thing. And you just always need more. As long as that's how Bitcoin works, that's what you need to do. But this is different. Like the model training is that initial period, and then the value comes from the inferences. The value doesn't come from a trained model that doesn't get inferenced is worthless.
Yeah.
And so I think the value over time goes to the people that have the infrastructure around making inferences better. And the one exception to that might be if there is some sort of constant training that's being done off of a live stream type of feed, where you're constantly retraining, and these are most likely techniques that don't exist yet, like mathematically in the computer science, but eventually having to run those at all times so that you're constantly producing new versions. Maybe there's some of that, but that's like, it's 2 levels beyond. I don't think people are really thinking in that direction.
So OpenAI keeps wowing people. Last week they introduced Sora, their text to video model. I'm sure you've been messing around with it a little bit, and it seems like every day there's a new crazy headline about Sam Altman, what he did do, what he didn't do, what he's doing that you don't know about yet, or that sort of thing. Is Sam Altman going to be the first trillionaire on this planet? Because I feel like he's in the catbird seat for it. I'm just curious thoughts, because I remember a time where we thought, what Bill Gates was worth, or Steve Jobs was worth, or obviously Elon Musk now supposedly worth hundreds of billions of dollars. It seemed like something that was impossible. $1 trillion market cap seemed impossible. Now we have $2-3 trillion market caps. You know what I'm saying? Like at some point, a guy like Sam Altman, he's going to turn into like the villain in Blade Runner. You know what I mean? Like, because he's going to, I don't know, he's just going to run away with it.
I don't know him personally. I've only listened to the, interviews that he's done. And I think like, having met people who are very wealthy, everyone's just people. Yeah. And I think if I'm being like very objective, there's probably a route in which OpenAI becomes that valuable, but I don't personally see it for the reasons I've just laid out, that like ultimately,
like OpenAI will easily be you called it Open API actually, by the way.
Did I?
Yeah, that's such a CTO move right there.
Open API 3.0 swagger.
So, but like
most important technical standard.
Pretty good chance that at some point $1 trillion market cap. If an NVIDIA can trade at 35 times sales or something like that, there's no reason why a company like this growing the way they are with the partners that they have and all that sort of stuff. But like again, you think that there's a good chance that maybe he is a bit more for the people a little bit.
I don't think that's. I'm not trying to make a personal. I just think like OpenAI itself. I don't know how it becomes a $1 trillion company, because like once the model's there, they just need to invest heavily into like how to actually roll that out for people to use it and people to pay for it. Like I'm paying $20 a month. Yeah. I don't think it's particularly worth it right now, because like anytime I pay, from a consumer perspective, anytime I start to get into a groove of doing something useful, I run out of quota, and then I'm like, all right, well, I'll wait 2 hours, and then I'm not doing it anymore. So like I don't see the business model totally there yet. Like they've got, I'm sure, an amazing licensing agreement with Microsoft, and that makes Bing awesome and all these things. But I think there's a lot more when it comes to the economics of this space.
Things rarely said in the last 10 years that thing that makes Bing awesome. You know what I mean? I'm just saying, not said too frequently. Listen, we covered a lot of ground. Really important, I think, the kind of, this discussion between these models going from the training phase to the inference phase. I just feel like this is going to be something we hear a lot, especially if some of these chip companies start disappointing. This is before AMD even has in mass scale like their competitive chip to the high-end processors that NVIDIA is doing. I think this could be a narrative of
totally. And you know what's funny about it is by the time we make that transition is when the actual value starts getting created. Yeah. It's like I can imagine a market narrative where you go, NVIDIA is done, so AI is done. Yeah. This thing is over. But actually, at that point, if they are actually no longer needed, they've served their purpose. Yeah. But that was the value comes through.
But that was my point. Is like stock market narratives are sometimes very different than what's actually happening in practice. And so, like, if you pulled forward all this excitement in such a small group of stocks, and they're the anointed ones, it's not likely to play out that way. I mean, that's been my experience over the last 25 years in the markets, and having a front row seat for the .com era inflation and then deflation, but then see what was kind of born in the ashes of that. That's where the $1 trillion companies were really born from. You know what I mean? When you think about it, what they did in the mid 2000s, really not what they did in the late 90s, if you will. So, all right, Trevor, we covered a lot of ground. I really appreciate all your color on this Capital One Discover financial deal, and obviously everything you had to say as far as the implications on fintech. Very interesting stuff, and of course this OpenAI and this battle that's playing out with all the hyperscalers and with upstarts like Perplexity. I find this really fascinating, and I think that like that's going to be the story of like how some of these companies grow into those valuations that they were kind of anointed with last year in the private markets, and if we ever see them in the public markets anytime soon, maybe they get gobbled up. Maybe we start to see some more M&A. Who knows?
Yeah. Let's see.
All right, man. Well, hopefully you'll come back very soon. I appreciate your time. Stick around, everyone. We have a great conversation in our Funders and Founders series with Ethan Agarwal and Ajay Kamat. And be sure to leave us a review and stick around for next week when we have Kara Swisher on. Leave a review, get a copy of her burn book. Thanks for being here.